Now.
Okay, I'll put my best voice on now.
Right.
Get started. You said you were expecting 20 people?
About 20 people, yeah.
Okay.
Um,
and so far it looks like all the mics are muted.
Yeah, it looks like we got 10 people in the room so far. So we'll give it another minute or so before we get started. But yeah, I see everyone is muted. That's good.
Did we use this format, Google, for the last recordings, or did we use something else for that?
Yeah, no, this is the same format. It's the only one that I have that I can do recordings and allows us to go over 1 hour.
Hi.
Hello, Elizabeth. Oh, your microphone is muted.
That's good.
Yep.
So
we'll go ahead and try and keep everybody muted for now.
Yep.
So what time of day is it over there where you are?
5 a.m.
Good morning.
I hope you have your coffee there. All right.
I was asleep on the sofa early last night, so it's okay.
All right. Well, so yeah, let's go ahead and have everybody remute their microphones. I've got 1 minute after the hour, and just for everyone that's just joining, we are recording this, and it'll be available on YouTube probably by the end of the weekend. But I will go ahead and just a general agenda is early on in this meeting, we wanted to talk about bonds and income purpose CEFs and interest rates, and really that was the initial focus of this meeting, and then get into some other Q&A stuff from posts in the Facebook group. But I'll go ahead and turn it over to you, Steve.
Okay, I've got it. And I guess if any of you have questions or comments, all you have to do is, I don't know, there must be a way to push a button or something, and Will know. You raise your hand, I guess.
Yeah, you can raise your hand, send me a message, or you can just, I believe you can unmute yourself.
Yeah,
and then they can jump in.
And then you can jump in and ask. The reason I wanted to talk about bonds and interest rates and things like that, because it just seemed to me from some of the Q&A going on in the groups that some people aren't separating well the idea of what the closed-end fund is versus what when they contain a portfolio of interest rate sensitive securities like bonds and preferred stocks and loans and liens and all those things that you know, like the average corporate bond when it comes out is like a 30 or 20-year entity. So you have to and all of these are negotiable instruments, which means they're for sale, and anybody who owns them, and most of the people that own the individual securities themselves are big investors and fund managers and stuff like that. Individual investors, in fact, I haven't seen an individual portfolio come across my desk in any of the accounts I manage or have taken over to manage in probably 20 years since I've seen an individual bond. So, you know, individuals pretty much don't buy these bonds anymore. They use mutual funds, closed-end funds, ETFs for that. But what you have to understand when you own a portfolio of them, that all of these bonds will fluctuate in market value with interest rate expectations. Brigitte, how nice to see you. You know, so when you're looking at a portfolio that contains 300 or 400 individual bonds, you have to realize that these bonds are for sale individually. And since interest rates have pretty much gone up almost 4 or 5 times since a year ago, that their market values are only going down, because if a person was to sell them, they would have to be selling them at a discounted value. But there's nothing that would make anyone sell them. They're all still paying their interest rates and their interest semi-annually. So, it's not a problem that the net asset value of a bond fund is going down in an environment where interest rates have been going up for a year. That should be expected. So what it tells you is, and there are many instances where investors like us realize that, and you got a portfolio there that probably has coupon rates of 3 and 4%. If they have some old ones, they might be in the 5% neighborhood, but you've got a portfolio of very low percents that we can buy in a group at a discount. We can buy the bonds at a discount, even though we may be paying a premium for the closed-end fund itself. And I know that kind of throws some people, that the premiums associated, if you take I think it's PTY right now, that has it's selling at a 20% premium, but yielding 10%. Okay. So even at that high relative rate between the market value and the net asset value, it's still yielding 10%. I see this as a wonderful benefit of the CEF vehicle, that we can take advantage of these high yields on perfectly good corporate bonds. I mean, even Treasury securities are selling at a big discount. So if we, and you notice that there aren't too many closed-end funds that just own Treasuries or just own federal government bonds, but even they are down in net asset value right now. So it's not something to worry about. It's certainly something that you have to make sure you understand. All right, so that's why I wanted to discuss these 2 points. The first two bullet points up here, or numbered points, that higher interest rate expectations, which we still pretty much have. I don't think anybody thinks the Fed is going to stop right now, or that we're going to start turning in the other direction. I think the news, the recession potential, may cause them to stop. I'm hoping it doesn't cause them to change direction too soon, and I hope that doesn't make you angry with me, but the longer this lasts, the more likely it is our managers will be able to buy higher yielding paper for the long run. So when I say here that higher rate expectations are good for us, it's good because of the opportunities it provides for us to literally buy these old bonds at an extreme discount and nearly double the yields we had a year ago on these very same securities, while the securities themselves continue to pay their interest. I have not heard, and I don't know if anyone else has, of any major defaults on the part of anybody. Even foreign, I haven't heard of anything defaulting. So it's a good place. So the exact opposite is true, and this is something we experienced since 2009 through 2020 and a half. The lower interest rate expectations that we had at all those times raised the prices of all these securities, right? And we benefited from that because we've been able to take profits on them for this whole long period of time. Okay, so any questions on that explanation of the bonds themselves, the container they happen to be in, and how it impacts you as an investor? Nobody's raising their hand. That means I'm not going to see any more of those types of, oh my God, it's a terrible bond market comments on the groups anymore. Okay, Ron, fire away. I think you have to Will has to allow, do you have to take care of that, Will, and let him speak?
I think I got it.
Oh, okay, you got it. All right.
All right. Do you have a rule of thumb on how much premium is just too much premium, and is the premium usually just based on supply and demand of investors going toward PIMCO as a favored bond house?
I would say that that's a lot of it. They trust PIMCO. I certainly do. But let's take a look at it, even at an equity that's always been like GUT, I think it is. I think it's been trading at a premium throughout its entire existence, and it's never seemed to be a problem for that security. I think the premium should be a function of supply and demand. It should always be and there's two things are gnawing at it. One is the misconceptions or incorrect perceptions a lot of people have about there being a direct relationship between, the prices of the net asset value going down is seen as bad, in spite of what causes it, and a rising net asset value is seen as good, again, regardless of what's causing it. And that's because they're all used to mutual funds and ETFs, where that's basically true, I guess. Closed-end funds are much more like individual stocks and the individual bonds themselves. They react the same way as an individual security. So yeah, it is supply and demand. It's also a misunderstanding on the part of some people. And another thing is there's a lot more people that know what they are that, like I would never sell any closed-end funds in this environment, at a loss, just, for any reason. So yeah, I'm not selling mine. So that makes them a little tighter. And the third feature is that there's a whole lot less of these out there in the marketplace than there are with the other types of securities that have a net asset value concern about them. Net asset values are a manipulated number also in ETFs and mutual funds. They have to take steps to make the number of shares produce the equalization in net asset value to share price. Does that help you?
Yes. One little addendum on that. So if you've got new cash coming in every month and quarter, and you have a choice of doing a PIMCO at 20% premium or a double line at 2% premium, relatively similar yields, would you skew in any particular direction?
I own, of course, both the double line funds and most of the PIMCO funds that meet my requirements. And when I'm doing new, I'd probably do either of those and new positions, and I'm happy to buy more, even at a premium if my PTY holdings may still be quite a bit at a quite higher price than they are today, as most of our stuff is. I'd still add to either of them, So I think that's a personal thing. How much have you got invested in them? Do you want to diversify further? Is it a new position, or are you adding to an old position? I have no expectation that everybody's going to do this the same way. And that's another one I think is one of the great opportunities we have here with these closed-end funds. We can all be doing relatively the same thing with different securities. You know what I mean? So yeah, I think if you stick with the high quality funds and you want to add one, if you feel you'd rather wait for a double line to get more popular after you own it so that you can sell it right away, that's smart, I would say. Yeah, either way, I wouldn't point you in either direction or say either direction would be wrong. I'm buying the PTY now at 20% premium. I'm buying the double line right now at 2% premium, and I'm buying things at a discount. I look at how it relates to my holdings already, and if I need more of it, or if I like it new, and then I look at the yield that I'm buying.
Okay. Super. Thank you very much.
Okay. Who's ever next?
Kevin.
Kevin?
Yep.
Hey there, Steve.
Hi.
Hey, when it comes down to looking at an individual fund, let's pick on PTY. I'd like to use CEF Connect and looking down at the credit quality and the maturity breakdown. Does that play a factor in your deciding whether or not? I mean, you've been doing it a long time, but if you're coming into this new as part of the assessment, I mean, I look at what's junk bond and below BBBB.
Yeah.
And, the maturity, if it's leaning towards, 1 to 7 years, higher number of groupings there versus, the longer term maturity. How do you kind of play that, or what's your advice here?
I mean, you can talk to 3 or 4 different people and you'll find those who think that the long maturities are the better things to hold. And you'll find others that say it's the short maturities that are the better things to hold. I like to see a ladder that has a lot of different maturities represented. I think that's a good thing in a fund, because what's happening in the future is not predictable, and they should have money coming in all the time to take advantage of whatever the situation is. But I look at two other things more. Again, like I said, the yield. But if you take when you open up the general spot on CEF Connect, okay, and I'm going to get this up on my screen so I know what I'm talking about. Just a regular view that shows you the price and the movement over the last couple of years, and putting in PTY. This is the overview, and on the right they have the net asset value versus the price.
Yep.
And I know you don't expect me to talk about net asset value, and I'm really not. But if you press the since inception button, you'll see the black and the blue lines, and you'll see how the price and the price relative to net asset value changes over the years. Sometimes it's the same. In this case, sometimes it's above, and occasionally it's below net asset value with this one. So I look at that, and I look at, in this particular case, this one's been doing it for 20 years. So you gotta trust an outfit or a manager or a fund that's been consistently within this price range for 20 years. The only time it's been below $10 was in the Great Recession, and that turned out to be a remarkable opportunity. The only time it's broken $20 is I guess at the end of 21, when everything else was up, and you can see the other 2 peaks on it. But otherwise, it's been in a pretty narrow range between $10 and $20 for 22 years. I think that tells you a lot about the fund and what you can expect. So right now, if you're buying it right now, it's at 20% premium, but it's below $15 a share. Okay. So even though it's at a premium, its price is still almost as low as it ever gets. So you see what I'm saying?
Yeah, definitely.
We can't predict the future, but we can look at the past. And even though this is exactly what I think they do, by the way, with Z scores, and I'm not a technical type guy. I look at this chart and I say, okay, that's the kind of chart I want to see in a closed-end fund. I want it to have gone down like crazy during the financial crisis, and I want it to have all these ups and downs that I can take advantage of over the years. And this one just fits that bill. So I would stick with this. I know we had a little discussion going on the other day, and Brian's not here to defend himself, but I look at this. I look at the same. If I can get it in here. Look at the same type of situation, the same type of chart on something like GOF, and I reached the same conclusion. I mean, it's between $25 and $15 for 16 years. And the only time it was below that was during the financial crisis. And the net asset value is below $15 right now, which means it's at a premium also, almost a 30% premium. A 30% premium, but it's still at the low end of its normal price range. So, hey, I think that's an opportunity. I do. So, because remember, the net asset value is not down because anything is bad. It's down because interest rates are up and the securities being held in the fund are reflecting that. So when interest rates go down, and they eventually will, or they'll just stabilize, or they'll be replaced with higher yielding ones, the net asset value is probably going to go up and the market price might not go up as much. So anyway, okay.
Thank you.
Okay, who's next? Anyone?
Sam, I think you had a question. Go ahead. Sam, are you there?
I don't know. I don't see him.
Sam Raymond, looks like he's going back and forth between mute and he's trying to well, it looks like he's unmuted, but Sam, I don't think your volume on your microphone is turned up.
You know, it's interesting. I haven't heard any backfeed or anything from anything this whole time so far.
Hey Sam, we can't hear you on your microphone. Why don't you send your question in the chat window, and we'll circle around back to it.
Okay, so I've covered 1 and 2, and if we don't have any more questions on that, and we talked a little bit about why bond fund NAVs change and what the consequence is. And I think we just answered that. You know, they change because each individual bond is sensitive to the changes in interest rates, and they're marketable securities, and there's nothing you can do. If you visualize, did I use the scales of justice? Did I use that in the brainwashing book to talk about interest rates? Didn't I? In any event, I have in the past. But if you just picture that, and you see when interest rates go up, the other side goes down. When interest rates go down, the price goes up. And we're talking about the individual securities inside the fund. And there are an average of 300 securities in these income funds. And they're all of different age ranges because of the laddering that you know a good manager does in a bond fund. So you know there's just so many variables going in so many directions at once. It has nothing, the net asset value in that case has nothing to do with supply and demand. Okay, so that's what, you know, they're two different things. All right, and if we've gotten through that and everybody understands it and can spread that knowledge to everybody else in the 3 groups, we've accomplished plenty today, and we can call it quits right now, except that we have all these other questions to deal with. Okay, can we move on to the other questions?
Yeah, so I'll just open it up to the floor for any further questions regarding interest rates before we get into the remaining questions, which are kind of all over the place.
I get, you know, there is interest rates and nobody's brought it up, and I didn't intend to, but interest rates do affect equities as well, because corporations have to borrow money. And if the interest rates get so far out of hand, rising interest rates are seen as something that may create a recessionary environment in the future. So one of the reasons I think the Fed will be reluctant to raise rates much further is because of all the recession chatter there is, I guess, mostly in Europe, right? More so than here. But, you know, a European recession is the same as having a recession here, because everybody's all over the place, and it's one big market.
Okay, it looks like we have another question from Kevin. Go ahead, Kevin.
Just a follow-up, Steve, on these bond funds. Then, how much attention do you pay to the leverage? You know,
again, it's not something I look at, Kevin. I understand, you know, you can see it. You could see it at work in the municipal bond funds, because if you think of them, they're really like a single sector fund. They only have they don't have a diversified portfolio. They do in every way they're supposed to, but they don't diversify into corporates or loans or other types of interest rate sensitive securities that might balance things out a little bit. They take it right on the head. And municipalities are are politically, their borrowing is politically controlled. I mean, it's got a lot attached to it. So when they see interest rates go up, they have a problem. Okay, and that's reflected in it's either that has made the managers cut their rates so extensively as they have, or the other thing is my conspiracy theory that they're really just taking the income and putting it into higher paying bonds instead of giving it back to us. And if they're doing that, in the long run, it's going to be to our benefit. So I really don't know. But I mean, if I were a manager running those funds, I might be thinking about doing that right now if I could get away with it. So
Interesting theory. So
I don't think it would be against the law or anything like that if they cut their dividends to use the money elsewhere. I don't know. But
so would you see, speaking of munis then, given that they've all fallen a lot, do you see it as a buying opportunity for a lot of your investment portfolios?
You double check the yields. And you may, if you've properly bought, minimal positions, and you don't have your 5%, and you want to help up the yield a little bit right now, check your yields first. You might want to add to some positions. I've actually taken a few profits recently. Even today, in two that I had purchased recently. Small profits, but just to raise the cash to reinvest. So yeah, you might have some opportunities in that area.
Thanks.
Okay, looks like a question from Elizabeth.
Hi, I just wanted to ask you, I was surprised a few weeks back when you made the comment on one of my posts about you don't concern yourself with the allocation across the tiers of the pyramid. So if we're focusing on income, which I am trying to as well, do you pivot towards kind of better investment grade bonds in this market and kind of less so on the lower quality bonds?
I in a way, the financial risk pyramid, which is what I call it, has been a little bit misinterpreted and used more as much as a diversification tool, when it's really designed, as it says under financial risk. It shows the relative risk between different types of investment securities, and this could be for the individual securities themselves or for the CEFs that contain them, and so its purpose is more like that. Having something in every floor of the pyramid shouldn't necessarily be something you want to do. You have to decide. I mean, if you want to be in the commodities markets or in the master limited partnerships, that's a distinct decision of risk that you have to make. You wouldn't want it to be a diversification decision, which would mean I must have some of that to be properly diversified. Do you see the distinction there? It's kind of it's kind of sketchy, I guess, and I've never written anything on that, but I know it's coming up right now. And we just did the diversification chapter in the book, and the writer, or I should say, we looked at it and we determined that, yeah, we should have the financial risk pyramid in the diversification chapter so that we can explain what all these different securities are at these different levels, because no matter what type of investing somebody's doing, they really should, even on the individual basis, they should know the difference between a large cap equity and a mini cap equity, right? They should know the difference in the risk involved, or a preferred stock being less risky than a common stock. They need to know that kind of stuff to invest. So yeah, we used it in there, but we also explained that diversification itself is more a function of the percentage that's involved in any individual security, the security itself, the closed-end fund itself, and a sector of the same securities, like 15% in a sector. But there are so many sectors that if you have 15% in one sector, just having a diversification problem, but you're missing out on a lot of other sectors that you should be in. We've come up with the idea that the diversification that we talk about in our groups is a much more offensive type of, and I don't mean that as insulting offensive, I mean offensive as opposed to defense like in football. It's a much more offensive approach, and that what I'm trying to do is have my fingers in every possible pie that there's out there that meets my quality requirements. So when the market starts to go up, wherever it starts, I'm going to be involved in that starting point, so that's why.
But so in
That-
this, but in this environment now, with your personal portfolios that you're managing, are you finding yourself to be steering away more from the lower quality bonds and
No,
the income funds?
not at
Okay.
all. Not at all.
Okay.
I'm not overloading in anything, and I never do. But no, I haven't said, no, wait a minute, I got to look out what I'm doing here. I'm not gonna go into the globals, or I'm not gonna go into the small caps. No, I haven't. I ever not found that necessary. I look at the things I said already. I look at that chart that shows me where that price is right now, the yield of what it is, and the third thing is the distribution history. And I want to be able to understand the distribution history. For example, if I see something going along and in 2008 through 2012, I see a reduction in its dividend, or I should say more recently, from then to now, if I see a reduction over the last 10 years, I say that makes sense because interest rates have gone down for 12 years, or interest rates have been at historically low levels for 10 years. The fact that this guy can still be paying nearly the same distribution is pretty good, and I guess it all depends on how good he is at using his leverage. I mean, how many of us used leverage back when interest rates got down below 2%? How many of you refinanced your homes?
Sure. Absolutely.
Everybody. I mean, some of us did it more than once. I have one client who almost did it, 4 times, I think. But yeah, I mean, that's leverage, guys. That's what leverage is all about. I mean, every corporation that we invest in, all these stocks that we love, I mean, Microsoft didn't get to where it was without leverage, nor did any of them that are at the top now. Any of the FANG stocks, believe me, they borrowed as much as they possibly could. The only difference between closed-end funds and regular stocks is closed-end funds give all the money to the chief executive officers, and the closed-end funds are required to give 95% of it to us. So
Okay.
all right. So where are we? We're talking about we talk about bad situations, and I would say, yeah, the what's their GLO.
So this was my question, and I can just elaborate on it. I already had a 2% position in GLO, and I also have 2% position in GLQ. And I had been averaging down on those, but I'm still down like 50%.
I know.
And then they cut the yield in half.
Right.
So I'm trying to figure out how to lighten up on those, and without going over my 2% limit.
Yeah, I have almost stopped adding to these positions.
So you're just going to wait it out.
And I'm saying when we get to the next market high, they're going to be top of my list for pruning losses.
Okay.
I think they may be, we'll see what happens. I mean, if we get a rise like that, maybe they'll come up with the rest of the ships in the harbor, But yeah, I don't like what they did. I mean, they made me confident. They lowered the dividend in January, right, last year. And then they went on, they didn't lower it again. So I said, okay, it was a one-time thing. They're fine. And I didn't hesitate to add to it. And then here we go. This year, they did the same thing again. At the beginning of the year, they cut it in half or so, right? So now,
right. Well, that's
now I'm kind I'm ticked off, aren't you? I mean,
Yeah. So
I
I
don't
think
like it. I don't like these guys anymore.
I
So
think that's because it's a managed distribution. I think they adjust it every January for the whole
yeah.
year.
All right.
So they only adjust it in January.
Yeah. So
'Cause-
let's see. I mean, how many of us have taken some profits already this year?
yeah.
Right. And these
Mhm.
are equity managers, so they certainly should have taken some profits already. Right.
Mhm.
So let's see if their managed distribution makes them. I don't know why I'm having trouble saying that. Why? 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 Let's see if that different approach makes them capable of raising the dividend this year because they've had better experience. I think it's a good test.
Mhm.
You know, and if we get to the end of the year and we're high up there and we've been making a lot of money, and this one's come up too, then we can make an intelligent decision. Are we taking our losses and licking our wounds and going away or not?
Mhm.
So,
Okay.
you know, there's no you know, this is the stock market. This is the bond market. It is a marketplace.
Yep.
The comforting thing is that in all these years, if you look back at the closed-end funds in these universes that we've put together, the number of failures is minuscule compared to the stock market. Minuscule.
Hmm.
And we're involved in the NASDAQ, and we're involved in junk bonds. We're involved in all the things, or we can be if we choose to. So,
Mhm.
okay. Do I ever look at premium or discount? I look at it like I just illustrated in that chart where it says the since inception chart. That's my was it Z-score? That's my look. I look at that and I see what's going on in the fund and I see what I think about the trends. And if you look at GLO, which I am now, you wouldn't like the trend because that trend is below 2008 levels for this guy right now. So that would, you know, so I still feel the same way as we just discussed.
Mhm.
So I don't look at premium discount per se as something in and of itself is going to make me change a decision in either direction. But overall, I want to see that relationship of a long-term trend within the same price range. If you look at the majority of these closed-end funds, like the ones we looked at before or the ones we've looked at already today, you'll see a very similar pattern where it's moving along nice, and then the financial crisis hits, and then you see it goes down steep then, and then it comes back up, but it never gets as high as it was before the financial crisis. That's pretty much what most of the good funds look like. So, you know, you can't go too wrong if that's your look. So no, I don't make decisions based on premium or discount. What does any tactical approach at all mean? I don't know who raised the question, but if you're here, I didn't know what to make of that question. I
Yeah.
feel like
Well, I
I
think
feel like I have lots of tactics going on, but I didn't know what this
no,
meant.
I think they meant tactical approach to premium or discount.
Yeah, it's not I guess all my tactical approaches then would be distribution history, all the quality stuff I talk about, current yield, you know, that's where I do.
Right.
And I do tactics in the management of the portfolios, as you all know. And I, you know, and I can't thank you enough, Scott and Will, you and Brian, the guys who came up with this idea of, you know, profit pruning.
Mhm.
You know, I got to tell you, I've taken many thousands of dollars in profits this year because I've started to use that. The dilemma that I'm in right now, and as you all probably know, I'm in a transitionary period where I'm not going to be managing portfolios anymore other than my own. Mhm.
Mhm.
And I'm going to be stuck with using the same software. And I, you know, and I can't thank you enough, Scott and Will, you and as a consultant for months until this transition is over. And now I'm really annoyed that I can't use this approach with IRAs, 401ks, Roths, you know, any of those types of things because of the software these guys have me using. And because they're using it themselves. I mean, it's not just me, but nobody in our particular firm can go in there on our IRAs. I can't do it on my own. My partner, I can't do it on my partners, you know. So,
right. So Rob just jumped in there with a question of what is profit pruning, and I guess any one of us could probably explain it, but basically the way that we've been talking about it in our little private groups is that, let's say that you bought a particular CEF, you started with a small position and the price has just gone down over time and you've been adding to it as the price goes down. And now you see that that closed-end fund has found its bottom and started working back up. You can, if you're able to sell individual lots within your, you know, maybe you started with 100 shares of a certain fund, and then over time you accumulated up to 1,000 shares. At some point, some of the later positions that you bought or the later purchases you made, they will return to profit quicker than the overall position. So you can start taking, we called it skimming, basically taking profits on individual lots without selling the whole position. Does that answer your question, Rob?
And just Rob says he got it. And just add that little bit to that a little bit. The beauty of it is that you are, by taking the profit, you're adding to capital, and by freeing up the dollars, even though they're not huge dollars like they would be when you sell a full position. And face it, in this market, we don't have many opportunities to sell full positions at profits. You have that money back in your hands to reinvest and put into other things at lower prices to increase yield at the same time. So it's really a neat approach. I do it a little bit differently from these guys, and that's, like I keep saying, that's one of the good things about this. It's subject to all these little individual quirks that we have. I haven't been taking any of those trimming or trimming profits under 10%. And that's probably because I waited so long to get started doing it, and I managed to have them that have gone up so much.
Okay.
But we've gone down a little bit now, and if we have another run like we had through that 3-week period where we went up, I mean, 8%, 10%, I might go in with a little lower basis to do it. I don't know.
Okay.
Okay, Ron has a question.
Back to GLO real quick. If you look at the distribution history, it's got almost a year's worth of return of capital only.
Yeah.
No earnings. Good sign, bad sign?
Both. Fortunately, return of capital is a direct reduction, a dollar for dollar reduction of your cost basis. So it increases your loss and you can invest it in something else, you know? So, right? Because you're getting your cost basis back. So that's a good thing. I think it shows that this change from a regular distribution basis to a managed distribution has been difficult for them. And let's see if they get better. I mean, yeah. I'm looking at that now. Yeah, it's almost dollar for dollar return of capital. You're right. So as of in May, it wasn't any. It was all long gain, and then by June, it was all return of capital. That's for 2022. So we'll see what happens this year. But yeah.
And that does come out of NAV, right?
I don't know. Why it depends where the dollars came from, I guess. If they're returning capital, they're returning. Yeah, it has to come out of NAV.
I know there's been other discussions about good ROC versus bad destructive ROC, but probably not for this call. So maybe sometime in the future.
Well, I think when people talk about destructive return of capital, I think you hit it on the head. They're talking about to the NAV of the fund. And I've always thought and I don't care about that nearly as much as I care of, is it destructive to my clients or my own personal? And I don't think it is, because it's a dollar-to-dollar return of capital, and you reduced your cost basis by exactly the same amount of money, and you've got that money then to reinvest in something else. So when and if GLO and GLV and GLQ get their act together and the prices start going up again, we're all going to be in a profit position sooner than we would have been without that return of capital. So it may be destructive to that NAV. I don't care about that as much as I do about the wash type effect it has on my investment in the closed-end fund.
And
So
as long as
Steve-
you're careful to
So
read
that might be just a rationalization. I don't know, but that's the way I look at it.
try to take any ROC and make it reinvestable but not spendable.
Right. And not normally do you have 100% ROC like this one. So when you have a portfolio, and where most of us are well diversified, and you have an average of, let's throw out a number, it doesn't matter. Let's say you're getting $10,000 a year income. A percentage of that's going to be return of capital. And I think one of the guidelines we've normally spoken about here is that even if you're taking money out, even if you're spending part of your income, you never want to spend more than 70% of it. Okay. I think that 70% guideline would protect you from spending any of the return of capital, unless all you have in your account is the cloud funds.
Right.
Okay. In most cases, you don't have that much of a return of capital.
I do know that when you're talking about taxable accounts and covered call funds, they tend to also label some of that income as return of capital.
I know, isn't that great?
Yeah, non-destructive.
Okay.
Thank you.
So Steve, on a monthly basis,
Yeah.
when are you looking at the dividend, the amount of each dividend that is return of capital, and are you adjusting your basis on that position?
I am not myself,
Okay.
but your broker dealer better be. I know Fidelity does, because from time to time you see the adjustment has been made.
Okay.
And usually it's not made during the year. They can't make it until they get that piece of paper from the fund at the end of the year that says how much of the distribution was return of capital. But usually in January and maybe February, you'll see working capital changes that you didn't initiate showing up on your account statement.
Okay.
I know in I think it was 2020. It may have been 21. Early in the year, all of a sudden I had a lot of profits to take, and I didn't, and that's what it came from. Not only were the prices going up, but they just reduced the cost basis because of the adjustment to return of capital, and I had profits to take.
Okay.
So it's not, I'm not many of my clients take as much as 70% of theirs, and I might be the only one of the accounts I'm managing right now that's been doing that, mostly for the vacations that I've been doing over the past couple of years. But hey, so it's certainly manageable. Okay, where were we?
We're on number 6, risk pyramid. And
we
may have already,
we
may have already covered that.
Yeah. Once I know the relationships in the risk pyramid. I know my asset allocation percentages, so I know where they all belong. You know what I mean? I know that from floor 4 down is my income bucket, and from 5 up is my equity bucket. And I know that I have very, very little in the 8th floor, personally or professionally, and I don't care about that. I've taken my hits on master limited partnerships personally and in closed-end funds. So I've had my fill of that one. So and I have to tell you, over the years, I've had some great successes with master limited partnerships, boy. But when they strike hard. And I didn't like that the possibility. And I'm old. I can't afford it. I can't afford to lose. I can't afford to lose money. So so I stay away from that. But yeah, we've talked about the risk pyramid. Anybody else have any questions about that subject, though? Okay. How do you build a buy list when the price is higher than yesterday's close? As a corollary to this list, Will asked me to produce a list of the 10 mistakes that I find people making. And the first one I put on the list sort of came to me when I read this question, because it kind of sounds to me like you're using the brainwashing book rules about, it's got to be down in price and all that to buy it and stuff like that. And buy list, it's got to be down 20% from its 52-week high and all those things. Yeah, that is my question. SPC. Who are you, SPC?
That's Sandra.
Oh, Sandra. Yeah. Okay. Yeah. So yeah, that's what my impression is, that the brainwashing book was developed, first edition and the second edition, during a time when the equity bucket was still mostly individual stocks. We had the S&P stock guide. I'd had that since my investment youth, to go through and find high quality securities. And then they took it away. Almost must be 15 years or so already. And so you couldn't get that kind of information. And then that, coupled with the way the market has risen since the financial crisis, it got to the point where if you applied the rule, you got very nervous about applying the brainwashing book rules to individual securities, because everything was up. If anything was down 20%, it made more sense to avoid it than it did to invest in it. You know what I mean? It just, when everything's up, like it's like when you have a rally and you have a sector where everything is up and you have one stock that's not up, that's not the one you want to buy. There's got to be something else going on that you're not quite sure of. And that's the way it got with individual stocks for me. And that's why I started saying, okay, from now on, these closed-end funds, much as I used to pan mutual funds and everything like this, these closed-end funds are not mutual funds. They're not the same. They don't have the same flaws. They don't have the same problems that mutual funds have. These are really managed, and they're really smart type investments, and they pay a whole lot of more income than individual securities. And I started using them exclusively. So I haven't written a book on closed-end funds. I'm doing that now. And you'll see that there are no 20% down rules in this book. There are no, most of those rules are gone, but the emphasis on quality and the emphasis on diversification and there's no more 10% profit rule either. That's a 5% rule now. So that, the rules have changed for the vehicle that I'm using. And we're very excited about getting this book out there. So try to avoid using the brainwashing ideas that are specifically about individual stocks when you're dealing with closed-end funds, because they just aren't the same. They're not the same. They're not the same security. There are hundreds of securities in one, and you can see why that. I mean, you might have a fund within your fund. You might have 150 different stocks, and you can't apply single stock rules to 150 at the same time. It just can't be done. So I think that question, Sandra, perhaps came from the ideas in the brainwashing book. I did write a book, an article called something about the transition, that the transition that I'd made in my processes between the two. But I don't think it went into detail of every rule that was in the brainwashing book, and I apologize for that. But yeah, there are different rules with closed-end funds. Okay, and it's your turn to make the question.
I just have a follow-up question. Thank you. I listened to one of the previous calls, and I had heard you talk about how the rules had changed somewhat. And there was something you mentioned there regarding that profit taking was primarily done on equity CEFs and not on income CEFs. As you know, I'm particularly just purchasing income CEFs, so I just wanted some clarification on that.
What did you just say about no, the equity rules are the same for all CEFs. I mean, the profit taking. The profit taking rules are the same.
Okay.
In fact, I think I've said somewhere that one of the most exciting things that you'll ever experience as an investor was when you can take a nice 3%, 4%, or 5% profit on a tax-free municipal bond fund. I mean, that's the epitome of a profit-taking thrill, when you have this tax-free income, and then on top of it, you get a year's income. So what if you make some capital gain, or even if it's at individual tax rates, even if you pay 30 or 40% in taxes, you still have 60 or 70% more money than you did, more capital than you did before you took the profit. Okay.
Yes. No. Thank you. Perfect.
Okay. All right. Any other? So that's what I was thinking when I saw that question, and I think we've just answered it. The buy list and the pricing are in closed-end funds. They're really two different issues. I wouldn't blame you if you saw that the price of a CEF was close to its all-time high, but the 52-week all-time high. But remember that we've been in the closed-end fund market. Our last all-time highs, portfolio-wise, were back in August of '81, when they first start talking about higher interest rates, way before the stocks started going bad. Okay, it was at least a month before the stocks in general stopped going up, and then we actually had an all-time high of the stock market on January 3rd of 2022. Okay, so we've been 12 years into this since the last all-time high, but did I say years? 12 months.
12 months, yeah.
12 months, sorry. And 18 months since the last all-time high, according to my manager here in the back of the office. Since any account has been at an all-time high, any closed-end fund account has been at an all-time high. So this has been a significant rally, or a significant buying opportunity for us, in the fact that we've had 18 months of buying closed-end funds at lower prices than the month before. That's not a bad thing.
Mm-hmm.
That's not a bad thing at all. Okay. All right. So when you're doing your buy list, you do it on the yield, the diversification, those types of issues. If you're looking at the relationship of price to past prices, I think you have to go back a little. We haven't had any all-time highs in a long time. So the 52-week high would be last February. And we'd already been 6 months going lower in the closed-end funds at that time. So that rule is another one that has to go down the loo with the others. General rules for trading when the market is in decline. I think we've said a little bit about that too, and particularly with this concept of taking it. We've bought so much stuff cheap when we've added to positions, and now when the market is a little, we've had a week. This has been a week of down market. Are we still down today? I don't even know. This has been a week of a down market, but we've had a very strong 6 weeks since the beginning of the year in general, and so a lot of these profits. Well, the Dow is up, NASDAQ's still down, and S&P is now up. So, but the breadth is now even. So we've got as much advancers as decliners, and probably not as many as advancers as decliners in the closed-end funds. But when the market's in decline, you do two things. You take whatever profits you can, you take whatever income you generate, and you do two things with it. You add to positions. You start at the lowest cost basis and the highest amount down. And you look at it and you'll see you can add to the ones. And I've been using 20% all along. I've started to say, okay, it's doing better. In some cases, I have to use 15% for what I'm adding to, but I'm also adding new positions because I know I might be able to turn around a quick profit in those. Okay, if we really are in a rally mode here. Okay. All right. So, anyone want to hear about what I think the list of mistakes are?
I think Elizabeth has a question there. How do you track rights offerings with so many holdings?
It's interesting that we have Elizabeth is in Australia, and we have Brigitte here who's in Amsterdam. And the rest of us here in the middle of them. But it's great to, we have really an international meeting going on here. This is very impressive. Do we have any of our Hawaii people here?
I don't think he made it.
No? Okay. All right. Then, so the rest of us aren't nearly any place as exciting as Amsterdam or where did you say you were, Elizabeth?
I think Elizabeth is in Australia.
I know she's in Australia, but what city?
Sorry, I was muted. I'm just outside of Brisbane.
Just out of Brisbane. Okay. All right.
I think you said you came to Brisbane before, right?
I was, yeah. We did pretty much the whole East Coast, and we went into the Rock. We went to Ayers Rock. We were on a talc tour, and they sort of jet you all over the place. And we did the reef up north, and we loved it. We loved it. And now we went to New Zealand, so it was a great.
Well, you're welcome to visit anytime.
and it's likely that we'll be back if we if our health continues to stay what it is. So anyway, okay, you had a question.
Yeah, so her question's up there on the screen. How do you track rights offerings with so many holdings, and how do you utilize them for trading and profit taking? So do you do anything at all around rights offerings?
I sell the suckers immediately and reallocate the money. I'm of the old school, I guess, and it used to be from you could buy more shares of something. There's always going to be, in my mind, there's going to be an artificial demand for it. And so even though they're going to give you a discount on the shares, in the old days, you used to be they'd say, we're going to do it without commission, is what they used to say, because there used to be commissions. But now it's still going to be an unusual demand from people just go ahead and accepting the rights, and they all buy them at the same time. You all execute them at the same time. So it raises the price just from that artificial demand. So I stay away from that. I select it, just like with the regular distributions. I don't drip. I selectively invest. Every dollar I feel deserves an intellectual process of where you're going to put it. Tenders and buybacks.
Ron, can you elaborate on your question?
Some of them, we've had situations where we can tender our XY, XCX, that mess we're in,
Oh,
that thing.
Invesco.
Yeah, that was really a shocker. I did not anticipate. I had taken most of my profits in small losses in that, but I had some that were left and I didn't take it. And when I realized what I got stuck with, I was really upset with myself.
Mm-hmm.
But normally, if they make a tender offer, I don't usually do what they want me to do. I'm kind of a contrarian in that sense. And every time Wall Street comes out with something new, like I think now the product of choice for major financial institutions is the model portfolios.
Mm-hmm.
And some people are even suggesting to Ken and I, Ken's my partner in this business, that we should construct models for our income portfolios, one for each, And I'm trying to figure out in my mind how that would actually manage to the benefit of the investor. And I can't come up with a way that it would benefit them. It's true, individual management, like what I do, having 300 portfolios to look at, and keep track of. And fortunately, I have a lot of good help. That doesn't happen much anymore. Most people are in funds, and model portfolios are taking their place, I think. It looks like you have an individually invested and individually managed portfolio with a low price of something like 50 basis points, but they don't tell you that the fund owner, the fund manager, is actually taking another 1%, and that the guy who sold you on the product is not making any of the individual decisions. And I would guess that if you have a situation where there are dividends being paid, they're all being automatically reinvested. So I don't know how we could run our style of selective investment and taking out up to 70% of the income. I don't know how we'd be able to do that in a model type environment. I think we can create a model portfolio that generates a whole lot more income for people than they're getting today. But I don't know if we could have it do what each of us is doing individually with our own portfolios and the way we're managing the closed-end funds. Okay. Did that help, Ron?
Yeah, and some other things I heard or kind of have seen online is that a rights offering is an indicator of dilution because there's going to be additional shares issued against the same portfolio. So one strategy is to sell the rights, sell the shares real quick because they're going to drop because people are going to think they're going to get diluted, and then buy them back once everything's the smoke clears.
I think that's not a bad individual, approach to a certain security. I wouldn't sell them at a loss to do that.
Yeah.
I think that would be foolish. So the rights that were offered earlier this month, those two, I forget who they were exactly, but they were, companies that do it often. I don't have any problem with them diluting my position. The more float we have in these things, the better for us. We won't lose our volatility, which we like, but it's helpful if there are more shares out there, in my mind.
Okay, good. Thank you, Steve.
You're welcome. Okay. So if there are no questions and people aren't escaping, I do have to leave right on time and a little early. A little early would probably be appreciated by my wife. I heard you aren't managed. Oh, okay. Yeah, that's what I just said. I am still managing all the accounts that I am now responsible for. And I think, Ron, this is probably the first time you've heard this. If you're the Ron, I think you are. Ron E. But yes.
I think that question was from Robert.
Yeah, but I was talking about Ron.
Okay.
Is that Ron Egan? It sounds like his voice, who is a client of mine and a very valuable client of mine. But yes, I am going to be no longer managing my accounts, but nothing else is going to change. It's going to be, the same people will be the same people will be there. We're working with the same management firm, the same broker dealer, and the two people that work with me in managing accounts will still be managing the accounts for me, and I trained them, and I hope that I've cloned them. So there's not going to be any changes, visible changes that anybody's going to see, and I will be staying on in a consulting capacity for a year, and all of my clients will continue to have access to me. Okay. And hopefully they'll all join these groups too. And I'm going to encourage them to do that. But to answer the question that, was it Bob that brought it up, Broussard?
Mm-hmm.
Yes,
Yes.
in the next few months, I will not be the principal account manager for my existing portfolios other than my own. Okay. So yeah, I'll still be, and my plan is to, as soon as that takes place, I will be available to do consulting work for anybody who wants portfolio help, suggestions, planning, all that good stuff. And I didn't mean to make this an advertisement, but I didn't ask the question. So that's what the plan is. Yeah.
Well, how would I get up with you then, with somebody there? I'm thinking about doing something here soon.
Well, I could hook you up with my firm. They do this. They would do exactly what I do, and I would actually, at this point, I'm still your point man to get that going. So, you want to call me on Monday, we can get started with it. Just contact me through the group, and I'll send you my contact information, and we can get started whenever you want.
Okay, thanks.
Right.
Appreciate it.
Okay. Any other questions, or do you want to hear my 10 thoughts on mistakes that people might make?
Go for it. Oh, we got
Okay.
Ron has another question.
One quick one, Steve.
Yeah.
You talk about selection universes. I imagine you have 3: equity, munis, and regular fixed income. Do you, within those universes, identify trading pairs so that if you do grab a capital gain on one, you have a standby ready to go, and that may change over time, but not very rapidly?
I have so many accounts and large accounts. I usually have both of the ones that you guys are talking about as pairs. Like like CHI and CHY, for example,
Yeah.
or some of the real estate ones like RQI and RNP or RIF, or those. I generally own them all. And occasionally, if I sell one, I won't necessarily buy the other one immediately. But if I'm going through my work, if I have an opportunity to buy it and it's there on the universe as I go through the universe alphabetically, and I select and I color code the ones I've bought for somebody recently, and I go on to the next one and next one and next one. And that's how I do it. It's so random, you'll probably think you should slap me along the side of the head. But what I've learned is that I trade these things so frequently, and they're all so similar in their patterns of ups and downs, that you don't have to overthink every selection. If I look at an account and it doesn't have ACV in it, and it can afford to, I'm going to buy it. Okay. There are ones like that I've been so successful with for the year that I just want everybody to own. GAB is another one I can think of offhand that I think everybody should have, because it's been so good to me all these years. But that doesn't, but I'm not going to do that unless it happens to be in my eyesight as I'm scrolling through my universe to make the next selection. And that's how I do it. It's totally, I guess you could call it unprofessional. What would you say? It's just, I recognize the similarities of all of them themselves, and also the similarities of the pairs that you're talking about. And I certainly am not going to buy CHI and CHY for the same guy in the same day. Okay. Because I know that. but I will buy it for the same portfolio, probably at different times.
It's experience
So-
and intuition. I get it.
Yeah, that's really what it is. And I'm sure in every professional aspect of your life other than investing, you probably approach things in the same way. You just know what you can do and what you shouldn't do. You just know. And that's the way I feel. It was even that way with individual stocks. I knew which ones I wanted. I knew if the market was down a bunch, I'd call up Ken and I said, what's Pepsi doing? Because I knew if I bought Pepsi, I'd make money on it. It was that type of thing. You just get to that spot. And you guys have been doing this. I haven't been doing closed-end funds not even half my career yet. It's between 15 and 18 years for me, I guess. And I've been doing this over 40. So, I'm just getting over stocks. I mean, they used to be my buddies. That's how I got where I am. I mean, they built my homes. The stock market did. So I have a love for them. I just think closed-end funds are easier and better and less work than those were. That's all. Okay. Anybody else have a question before I get into this?
So yeah, it looks like Elizabeth put another question in the chat window. Is there a market value percentage down threshold that raises alarm bells for you, or if the thesis remains the same, do you just add to them if they're not overweight?
I think it's almost yes and a yes to the second half. Earlier I spoke about when you look at something like the chart on the PTY we looked at,
Mm-hmm.
you see, you look at the since inception chart of many CEFs, they'll be just like this PTY. And when you see that price is within that range, in PTY, I'm looking between $20 and $10 for 21 years, up and down. It's rarely been over 20. It's only once been below 10, and that was in the financial crisis. And that turned out to be the most significant buying opportunity, even bigger opportunity than the crash of '87 was. And most of you, I guess, are too young to even know about that one. So, it's just, I look for this pattern. And if it's in that pattern, that's really enough for me as far as the price relative to anything else. I look at yield and the price. And the price is, when do I buy it and when do I sell it? Those are the two things I look at market value for. I don't think I answered both parts of your question. Or did I? Elizabeth?
Sorry, I was just taking a note. No, I guess what I'm saying is like the GLOs and GLQ. I'm just curious
Oh,
if there's
yeah.
a time when you're looking at a portfolio that's in red.
I'm
If
looking
you just go, right, I'm going to add to them, or I'm just going to ride this out and not worry about it.
I pretty much stopped adding to the GLO at this stage. I'm saying to it, I'm going to look at this one real carefully and see how it does during the next rally. If it rallies with the rest of the world, fine. I'll assume that its managed distribution approach will be adequate going forward. If it doesn't, I'll probably start taking my losses on it at the high of the market, and that's when I take losses.
But would you say that? So let's imagine it's not GLO or GLQ, and just some of the holdings are down 20, 30, 40%. Do you just even break a sweat on those, or do you just add more, or just ride them out?
I pretty much ride them out. Yeah, particularly when the market is still down 15%. The closed-end funds on average are down 20%. I mean, just 18 months ago, 75% of my securities were in the green. So, things change quickly in this. And if 18 months is quickly in market terms, really. So I'm sticking with it. I mean, even at this price, they're paying a nice yield. Their yield on my cost basis is probably below what I'd like it to be. But, I don't take losses in down markets. unless it's a situation like we talked about with before, like somebody decides to abandon the fund and they're going to liquidate, I'll take my losses before it liquidates, probably, you know. So yeah, maybe I've gotten burned sometimes in my career for riding it out, but they are managed funds after all, and when they're particularly, if they're in a fly-by-night or a management company that only has one fund, or one I've just started to use, like I was just thinking of adding about 3 different ones to my equity universe that are with management companies that I don't have any in right now. If it was in one of those newbies, yeah, I'd probably be a little bit more prone to saying goodbye sooner. And that's why I'm saying that with Clow. Those are the only 3 I have, and they all suck right now. So, hey, you know, so I'm not going to hang on and be stubborn about it for too long, actually. So, okay. Okay, there are mistakes that people make in general, and I know that I've probably mentioned every one of these in conversations in the groups. So I'm just going to go over them, and you can think about them or ask questions. But I think I already mentioned the first one, and that's trying to apply the brainwashing book rules, which were in equities, which were subject, where the subject was individual equities, to closed-end funds. It really shouldn't be done. We talked about that. The most important thing of all, when you know all the rules and the quality, and you create a selection universe, is overthinking things like a lot once your universe has been established, or double second guessing yourself, or like we were just talking about, which one should I pick or should not pick. You've already done the selection. You've already I know some of you, I say it's got to be in business 5 years. I know I think it was Sandra who said she selected and they have to be 10 years. That's great. That's perfectly good. There's plenty of them that are over 10 years. You've all made these intelligent, informed decision about what's in the universe. So once that's done, don't overthink it at that point. You've done the homework. You should be able to use what you've decided on. Automation. With closed-end funds, we really have a lot of guidelines. We don't really have rigid rules that must be applied. Let's say you're in another situation, hopefully a year or 2 from now, where we're at another all-time high in the closed-end funds. And instead of having a rare 5% profit that you must take, all of a sudden you have 15 positions that are up 5% or more. Sell 3 of them. You don't have to sell all of them, even though Steve said sell at 5%, because you don't have that much anymore to invest in, and it takes some work to do that. You might have to add to your universe to accommodate the new money. You don't have that much to add to in the way of adding in. So you don't want to, a lot of people say, don't fight the market, and that would be a case. When you're at an all-time high, you may want to be, you're not being a little bit more greedy. You're not being more greedy. You're being more practical. You're not saying, I'm going to hold on for 8%. You're saying, I'm just not going to sell all my 5%ers, So, think about it like that. The rules are guidelines. I don't put stop loss orders in. I don't put buy orders in. I do each trade individually each day. A stop limit order to buy, a stop limit order to sell. There are no other orders in my investment management. So I think it's I think it's a mistake. Even in closed-end funds, you'll occasionally have a closed-end fund that'll go up 1.5 points in a day, and if you've got a 5-cent profit, an order in there in advance, you're going to miss it. You're going to lose that benefit. I wouldn't do it. Just, if you want to spend a lot of time, make sure you do your daily limit orders. I think most of the people I haven't heard anything. I haven't heard one person in this conversation say anything about market value problems and total return. So I'm hoping all of you no longer have a market value or a total return focus. It's really not appropriate for a closed-end fund portfolio for all the reasons. And the main reason is they have to give out 95% of the income they make. If Walmart had to pay out 95% of its income to shareholders, where do you think its stock price would be? You know, stocks you can't judge these things by the same rules you judge stocks. Total return just doesn't have a place here. If you look like with that PTY we just looked at, in 22 years, it's never been above $25. I mean, a stock, somebody analyzing that from a total return perspective would say, God, that is the worst thing I've ever seen. That's ridiculous. That's not good performance. That's terrible performance until they see that they've been paying you 10% the whole time, you know? So, you know, it's that type of thing. You got to get away from that. And I know it's difficult for a lot of people to do. Some people have the capability of adding to their investment portfolios, and they say, not going to do it now because the market's going down and I'm going to wait. I'm going to keep my powder dry. Things like that. Those kind of comments raise the hair on the back of my neck. I've had probably between 100 and 150 clients for the last 30 years. And I have to tell you that there aren't a dozen of them who have added to their portfolios during market corrections. Can you believe that? And they're experienced with me and they've heard all my stuff. Even my wealthiest clients, you know, have never, ever added to their portfolios. I have some who religiously add 100, 200, 500, 1,000 every month. And I have others who have just never done it. It's really phenomenal. Okay. Another mistake, and again, I don't think there are a lot of you that would be doing this, is not selling enough during rallies. I think most of you, okay. How do you add to an IRA when there's no earned income? Why would you have an IRA with no earned income is my question.
No, Steve, the question is, you're saying clients aren't adding to their portfolios, but in order to add to an IRA, you have to have outside.
Oh, okay, that's true.
An
IRA, you have an excuse in an IRA, but I have a lot of individual portfolios that don't have that excuse. Okay, but I was meaning when you could, you know. But you're absolutely right. You can't add to those IRAs. Okay. I think I harp on this more than anything else, is drip investing and dollar cost averaging. And I've added my third point, and that's model portfolios, which some of you may have in other places that you should examine closely whether you really want to be in that type of environment. Another mistake, particularly in the income bucket, is holding too much cash. And what I mean by that is holding cash in excess of your emergency fund or the amount necessary to, if you are, and most of you are not in a fee paying environment like my clients are. I have to hold a reserve for their fees. But if you have you're going to redo the kitchen 6 months from now, you're going to start putting away cash, but unless it's for something like that, the idea of holding cash is really market timing, no matter how you slice it. If it's not for some purpose that you're going to spend it, and to wait for a better opportunity, that's just market timing. Another one is owning too few securities. Maybe it's inconvenient. I've heard some people who have, oh, we had that one guy. Remember, there was a guy in one of the groups who said he had a $300,000 portfolio and he hadn't had one fund. Can you imagine? How could you sleep at night? You know? So owning too few securities, and I spoke about it earlier. You know, in the book, we're going to talk about this concept of, in most cases, diversification is really a defensive strategy. It protects you from risk because of the minimal amount you have in all these securities. But I think of it as much as an offensive strategy, because there've got to be 37 identifiable sectors, and we have at least 28 different categories or types of CEFs in our financial risk pyramid. There's just so many different things going on that limiting yourself can cost you money. It can cost you money by only having CHI and not CHY, for example, because you only have 40 and you don't want to duplicate types. That could cost you money. Take your time, find some things you want to add to your universe, add them, and now you have 55, or now you have 45. Okay, you don't have to own them all right away, but at least you're looking at them. And look at 50. Then eventually you get my spreadsheet and you say, okay, I'm going to look at 100 of them. I'm going to select. I'm not going to own them all at once, but I know I've got 100 out there to look at. Don't limit yourself to 40 or less. I mean, it's not 5% per. I think you're missing something if you do that. And then the final thing is letting taxes influence your decision making as to either regular income or profit taking. And it's like, how many of you have ever walked into your boss's office and asked for a cut in pay? Or how many of your accountants have ever told you, don't pay me this year, I got too much money, Steve, I don't want to have to pay more taxes. You know, that's what you're doing when you're saying no to a profit or no to a higher income generating portfolio. That's literally what you're doing. You're saying no to more money. You're walking by the $100 bill on the sidewalk. Okay, that's it. And if you don't make any of those mistakes, you're going to be very successful at this. All right, any other questions before we say farewell? And I tell you, it's really been a kick. I've never done one of these where I've had literally worldwide participation. It's really been super fun. And welcome to my office. I guess you've all noticed my office in the background here. So it was so nice to have you all. And if there's no more questions, we'll sign off and we'll talk to you in the groups.
All right. Well, thanks, everybody.
Thanks.
Okay. Yes. Have a great weekend, everyone.